Welcome to Finantax Clips. Today we will be discussing how to master your credit score and boost your financial reputation. But before we dive headlong into the nitty-gritty, let's take a moment to understand what a credit score is. Think of your credit score as your financial report card, an essential tool that lenders use to gauge your credit worthiness. It's a three-digit number that ranges from 300 to 850, with 300 being the lowest and 850 being the highest. Your credit score is like your financial reputation, painting a picture of how well you've managed your finances and credit obligations in the past. The higher your score, the better your chances of getting approved for loans, securing lower interest rates, and even snagging that dream apartment or job. A credit score is calculated based on 5 key factors: your payment history, the amount you owe, the length of your credit history, the types of credit you use, and how often you apply for new credit. Each of these factors carries a different weight in the calculation, with your payment history and the amount you owe having the most impact. Over the course of this video, we will delve into each of these factors, offering tips and strategies on how you can improve them. We'll explore how to understand your credit report, the importance of making on-time payments, ways to reduce your credit utilization, the benefits of limiting new credit, and the advantages of diversifying your credit. Maintaining a good credit score is not a sprint, it's a marathon. It requires consistent effort, smart financial decisions, and a good dose of patience. But with the right information and tools, you can take control of your credit score and boost your financial reputation. Now that you know what a credit score is and why it's important, let's delve into how you can improve it. To start improving your credit score, you first need to understand your credit report. Think of your credit report as your financial report card. It's a comprehensive record of your credit history, compiled by major credit reporting agencies. Lenders use this report to assess your credit worthiness, so it's important to know what's in it. But how can you get your credit report? Well, you're entitled to one free report every 12 months from each of the 3 major credit reporting agencies, namely Experian, Equifax, and TransUnion. You can request this through their respective websites or through annualcreditreport.com, a site authorized by federal law. Now let's delve into what your credit report includes. First up is your payment history. This is the most significant factor that affects your credit score. It records how consistently you've made payments on time for your bills and loans. Late payments, bankruptcies, and foreclosures have a negative effect, so aim to pay your bills on time every time. Next, we have your debt or credit utilization. This is the ratio of your outstanding debt to your total available credit. A lower ratio is better as it shows you're not over-relying on credit. The length of your credit history also plays a part. It's the span of time since your oldest account was opened. Older accounts are beneficial as they demonstrate a longer record of managing credit. Then there's new credit. If you've opened several new credit accounts in a short period, it can signal risk to lenders and negatively impact your score. Finally, the types of credit you have. A mix of credit cards, retail accounts, installment loans, and mortgage loans is seen favorably as it demonstrates your ability to manage different types of credit. So, there you have it. Your credit report is a crucial element in shaping your financial future. It's like a financial mirror reflecting your habits and behaviors. The more you understand it, the better you can manage and improve your credit standing. Once you understand your credit report, you can start working on improving your credit score. The first step in improving your credit score is ensuring you make your payments on time. Let's delve into the world of on-time payments and its significance in shaping your credit score. Picture your credit score as a financial reputation that you build over time. In this reputation-building journey, punctuality plays a crucial role. Just like how a missed deadline can tarnish your professional reputation, a late or missed payment can negatively impact your credit score. There's a simple reason why on-time payments carry so much weight. It's because they reflect your reliability as a borrower. Creditors want to see if you can manage your debts responsibly. So every late payment is a red flag to them, signifying potential risk. Now, let's talk numbers. Payment history, which includes your on-time payments, makes up a whopping 35% of your credit score calculation. It's the single most significant factor in your FICO score, the most commonly used credit score model. So even one late payment can cause a substantial dip in your score, especially if you previously had a high score. And remember, severe delinquencies like charge-offs or collections can stay on your credit report for 7 years. But don't worry, there are strategies to ensure you make your payments on time. One effective method is setting up automatic payments. It's like having a digital personal assistant that never forgets. Your payments will be made on time every time without you having to lift a finger. Another method is setting up payment reminders. Whether you use a digital calendar or a good old-fashioned notebook, reminders can help you stay on top of your payment schedule. In the end, it all comes down to consistency. Consistent, on-time payments show creditors that you're a reliable borrower, which could open doors to better credit opportunities in the future. Remember, consistency in your payments is key to a good credit score. Next, let's focus on reducing your credit utilization. Picture credit utilization as a ratio, a comparison between the amount of credit you're using and the total credit you have available. It's like a financial seesaw. On one side, you have your current debt, on the other, your available credit. The balance between these two determines your credit utilization rate. Now, why does this matter? Well, credit utilization is a key player in the calculation of your credit score. In fact, it makes up almost a third of your FICO score, one of the most commonly used credit scoring systems. A high utilization rate can be a red flag to lenders, indicating you might be over-reliant on credit. On the other hand, a low utilization rate suggests you're managing your credit responsibly. So, how can you reduce your credit utilization? The first strategy is straightforward: pay down your balances. This decreases the amount of credit you're using, tipping the seesaw in favor of available credit. Regular, timely payments are key to maintaining a low utilization rate. Another strategy is to keep your credit card balances low. This doesn't mean you should stop using your credit cards altogether. Rather, aim to keep your balances below 30% of your credit limit. This shows lenders you're not maxing out your cards and you're able to manage your credit well. Lastly, consider increasing your credit limit. This can lower your credit utilization rate by increasing the amount of credit available to you. However, be cautious with this strategy. A higher credit limit doesn't mean you should increase your spending. Remember, reducing your credit utilization is a marathon, not a sprint. It takes consistent, mindful financial decisions, but the benefits are worth it. Reducing your credit utilization not only improves your credit score, but also your financial health. Another way to boost your credit score is by limiting new credit. This may seem counterintuitive, especially when we're often encouraged to diversify our credit. Yet, it's crucial to understand that opening new credit accounts can, in fact, temporarily lower your credit score. Every time you apply for a new loan or credit card, the lender performs a hard inquiry on your credit report. This indicates to credit bureaus that you may be taking on additional debt, which can be seen as a sign of financial risk. Each hard inquiry can shave off a few points from your overall credit score, and while the impact may be small, it can add up if you're not careful. Moreover, having too many new accounts can lower the average age of your credit history, another key factor in determining your credit score. Lenders want to see a long, stable history of responsible credit use. So, the more seasoned your accounts are, the more beneficial they are for your credit score. So how can you limit new credit? One approach is to be strategic about when and why you open new accounts. Only apply for new credit when it's necessary and beneficial for your financial situation. This doesn't mean you should never open a new account, but rather, do so with caution and thoughtfulness. Also, resist the temptation of signing up for every store credit card offer that comes your way. While they may offer tempting discounts, the long-term impact on your credit score may not be worth the short-term savings. Finally, consider using what you already have more effectively. Instead of opening a new credit card, perhaps you can ask for a credit limit increase on an existing card. This could potentially have a positive effect on your credit score, as it can lower your credit utilization ratio, provided you don't increase your spending. Remember, it's not about having many credit accounts, but about managing them well. Mastering your credit score isn't just about the numbers, it's about making smart, strategic decisions that set you up for financial success. Lastly, diversifying your credit can also help improve your credit score. Now, it's crucial to understand that diversification in this context doesn't mean spreading your debt across various credit cards. Instead, Credit diversification refers to having a diverse range of credit types under your name. So what does diversifying your credit look like? Well, it involves having a mix of credit cards, retail accounts, installment loans, finance company accounts, and mortgage loans. Each of these credit types represents a different way in which you can borrow and repay money. Let's break this down a bit. Credit cards, for instance, are revolving accounts, which means you have a set credit limit and you can borrow against it as often as you like, provided you pay off your balance. Retail accounts work similarly, but are specifically tied to a particular store or company. Installment loans, on the other hand, are loans you borrow once and pay back in regular, often monthly installments. This category includes things like student loans, auto loans, and personal loans. Finance company accounts are another type of credit, typically offered by companies that aren't banks, like consumer finance companies. Last but not least, there's the mortgage loan. This is a type of installment loan, but it is specifically used for buying property. Now you might be wondering, why should you bother with all of these different types of credit? The answer lies in how credit scoring models work. They like to see that you can handle a variety of credit types responsibly. It shows that you're capable of managing different repayment structures and credit agreements. So if you're looking to boost your credit score, consider diversifying your credit. But remember, it's not about opening as many accounts as possible. It's about responsibly managing a healthy mix of different types of credit. To wrap up, diversifying your credit is a powerful strategy for improving your credit score. A healthy mix of different types of credit can demonstrate your ability to manage different types of credit responsibly. Now that we've covered the main steps to improve your credit score, let's summarize. In our journey today, we delve deep into the nuances of credit scores, those elusive numbers that hold so much sway over our financial lives. We started by understanding what credit scores are and how they're calculated. We realized that they are not just arbitrary numbers, but a reflection of our financial responsibility. We then moved on to unravel the mysteries of our credit reports. We learned that these reports offer a comprehensive view of our credit histories. They tell potential lenders about our past and present credit activities and how well we've managed our debts. Understanding these reports is the first step to improving our credit scores. Our discussion led us to the paramount importance of making payments on time. Each on-time payment we make is a positive mark on our credit history. Conversely, late or missed payments can significantly harm our credit scores. Therefore, setting up automatic payments or reminders can be a game changer in our journey towards an excellent credit score. Next, we tackled the concept of credit utilization. This is the ratio of our outstanding credit balance to our total available credit. We learned that a lower credit utilization rate is better for our credit scores. Hence, paying down our debts and maintaining low balances on our credit cards is a smart strategy. Following that, we discussed the need to limit new credit. Each time we apply for new credit, a hard inquiry is placed on our credit report, which can temporarily lower our credit scores. Therefore, it's crucial to only apply for new credit when necessary. Lastly, we explored the idea of credit diversification. Having a mix of different types of credit, such as credit cards, retail accounts, installment loans, mortgage loans, and finance company accounts, can positively impact our credit scores. It shows lenders that we're capable of managing different types of credit responsibly. So, there you have it. These are the key steps to mastering your credit score. Remember, each step is important in its own right, but it's the combination of all these steps that will truly boost your credit score. It's important to note that improving your credit score isn't something that happens overnight. It's a process that requires patience, discipline, and consistency. It's about making small, manageable changes to your financial habits and maintaining them over time. In conclusion, your credit score is more than just a number. It's a testament to your financial reputation. By understanding it and taking the right steps to improve it, you can open doors to better financial opportunities. Remember, improving your credit score is a journey, not a sprint. Consistency and discipline are key. Thank you for tuning in to Finantax Clips. Don't forget to subscribe for more financial tips and advice. See you next time.